Hello everybody, Senior Analyst Kyle Custer here with another weekly update. And we're going to look at this week a little segment I like to call From the Fed. And what I really want to keep an eye on is what is coming out from the Federal Reserve presidents or top officials in the FOMC. Any sort of information that we can glean from their statements that they're putting out there. James Bullard really came out in the last couple months with some key input on how the St. Louis Fed is going to be looking at where their projections are for the Fed funds rate. And I like to equate the Federal Reserve, each of the branches of it, seem to come out with all kinds of great economic information, point you in a certain direction. But when they all come together, they're extremely vague. So we're going to try to look at them separately. So James Bullard, president of the Federal Reserve Bank of St. Louis, came out with a couple articles or a couple speeches that he did. He has some great quotes. It's a little bit of an economic lesson today. He comes out and says, monetary policy cannot permanently alter long-run growth rate. He goes on to say monetary policy can only pull some of that growth forward in exchange for less growth in the future. And I think the media is really missing out on these two key factors about how their actions at the Fed aren't going to permanently shift our growth in the United States. That's not how monetary policy works. It's more of you're trying to gauge and level off any sort of uncertainty and large swings in growth. So trying to abate any sort of chance of deep recessions by changing this monetary policy and implementing it. And he goes on also to say that the key for growth here in the United States is productivity. And we can achieve better productivity, which we're at extremely low level of productivity. In fact, I think the last release indicated a negative change. And in the United States, we need to focus on technology, investing in our infrastructure through government funding, and of course, human capital. So here you have education. Technology is, of course, going to be tied to research and development. And that's what will, in the long run, push our GDP from this very flat 1-2% area as we begin to implement new and exciting technology. His last big thing is really trying to explain how he and those at the St. Louis Fed are projecting the federal fund rate. And that is represented by this I here. And this is using the Taylor rule. Dr. Ed's mentioned this a few times. And I really wanted to bring it back because James Bullard is really hitting this home. This is how he's looking at it right now. And this is why he thinks rates aren't really going to be changing that much for the next maybe even few years. Here we have the gap between inflation expectations and where our inflation rate is right now. There's several different ways to look at inflation. Bullard uses the Dallas Fed's PCE. And that's how he factors this in, and he says it's basically the gap is pretty close to zero. So let's get rid of that. This is the unemployment gap, where full employment is as defined by whoever's filling in the equation. So Bullard says he thinks we're at pretty close to full employment. So the gap there, he says, is around zero. So then we get this equation. You got the federal funds right here, and you got this R and the cross, and we'll get into that in a second. But then you have the plus 200. The 200 is the 200 basis points where the inflation target is. So what is this? This R represents the difference between a short-term risk, very low-risk investment. He uses a 1-year treasury. The difference between that and current inflation, well, what it comes out to be is around, he looks back a few years, and right now he's saying it's around negative, that spread is around a negative 1.34, puts us around 66 basis points is where he's seeing the federal funds rate for the next year or so. And here's a chart. It's a little difficult to see. Here's where the Fed funds rate has been moving lately. And then you start to see, and we've talked about this before, the FOMC dot plot. These are the green ones. Those are the averages out till 2019. Longer run, you're looking at a Fed funds rate, anywhere between 75 basis points and all the way up here around 300. But using the Taylor rule, the St. Louis Fed is saying out as far as 2019, we may be still seeing around a 75 basis point federal funds rate. So again, that's using the Taylor rule. It's been around for a while, and it's something that the St. Louis Fed is really starting to change the way they look at policy, and really are starting to implement using the Taylor rule. So that being said, I don't know if this is going to be the case for the next 3 years, but in there's some recent speeches at St. Louis Fed, that seems to be what they're indicating. Thanks very much. Have a great week.